welcome to the CGBN webinar. This is our monthly webinar where we invite commercial practitioners from all over the world to talk about hot topics in real estate, and we try to also highlight their countries. However, this month we are doing a little bit different in that at the beginning of the year, we also like to highlight the U.S. and give some of the promising commercial real estate trends that we are seeing in gateway cities. A few ground rules. We ask that everyone please have their cameras off and muted. You are welcome to share your contact information in the chat room, as well as ask questions. We will have a Q&A. The format will be me presenting here. Ahmed's going to talk a little bit about the global side of things. We'll come back to Brandon, and then he will present the information afterwards. Everyone will have a chance to ask him questions about trends in commercial real estate. He is an expert. I'll come back to that in a moment. And then if you have any questions, whether it be about this or in the future, feel free to ask in the chat as well. We do have these sessions recorded. We put them both on the NICAR page, which is currently down at the moment, but we're trying to resolve that, as well as a YouTube, the NICAR YouTube. So you can reference these sessions later if you had questions or wanted more information. So Ahmed, can you tell us a little bit about the global side of what we're doing and any additional information, NAR, NICAR, or otherwise?
Thank you, Teresa. Good morning, everyone. First of all, thank you, Brandon. Really appreciate you taking time out. It's been always a pleasure getting your take on things. You've been kind of spot on, man. Every year after year, I have had the opportunity of listening to you. But as you can see, the folks and the names, we have Portugal here. Antonio, welcome, my friend. We have Tinubu from Nigeria. So our audience is pretty international. And we also have Alexander Jerry from Champaign, Illinois, one of the largest foreign student campuses in the country. Peter, our chair of the president of NICA is on here. I don't see Peter. But anyway, so there's a few different parts to this. I belong to Main Street Organization of Realtors as a primary member, which has a very robust international global council. And then I'm a secondary member of NICA. NICA is a overlay commercial board for NAR. And so this has been a great platform for us, showcasing through our partners and through our friends throughout the world. We've had a development in Nigeria that we showcased called Alaro City. And the connection to Chicago was through the architectural firm in Chicago, through their London office, was one of the planners of that project. So there's all these connections that come about. Just did the thing on Nigeria, on the Philippines. So we're all over the world. This particular format is meant to highlight, you know, different facets of commercial real estate, which includes development, economic forecast, what's going on in your neighborhood, what's going on globally. So through NAR, we have partnership with over 100 organizations in over 80 countries around the world. At the end of next month, part of us that belong to I represent 3 countries in Africa, but also through NAR that represents that region. We're going to be having, we've been invited to go to a conference there. So there's this interaction, continuous interaction. This platform is not for marketing your properties, but you get that opportunity during networking to talk about a property that you may have that you want to, you know, can be anywhere in the world. So Alina Avi, I see Alina is on. Alina is our regional coordinator for NAR for Eastern Europe, Middle East, and Africa. So she covers a very wide region. Is there a way to get Alina on for a second? I'd just like her to introduce her, please.
Hello, everyone. Happy New Year. I wasn't prepared to be on, so I'm sorry that I have the camera off. But I like to say hello to everyone and Happy New Year. And I'm excited to find out the latest information and predictions. It sounds like an exciting program. Thank you for organizing. What could I say? That we will continue to cover the region and bring also more commercial programming and updates from our region. And yes, we're having a very exciting upcoming trip to South Africa.
Thank you, Alina. Thank you, Teresa. It's all yours.
All right. Thank you very much, Ahmed. So again, a reminder, if everyone keep their videos off and chat or their volume off, you're welcome to put any information in the chat and save the chat at the end. And I would like to present Brandon Svec, who has an extensive background in commercial real estate. He is the National Director of U.S. Retail Analytics for CoStar. And I think I met him at a presentation many years ago and feel he's an eloquent speaker, has so much knowledge that he can share. And if he can't answer here, which usually he can definitely find out the answers for you. So without further ado, Brandon, if you could tell us what's going on throughout the U.S. and some of these gateway cities, we would love to hear what you have to say.
Absolutely. Great, Teresa, and thank you for having me. So great to be with everyone today. As Teresa mentioned, my name is Brandon Svec. I'm the National Director of Retail Analytics for CoStar Group. And away we go. So we're going to run through this relatively quickly. As always, I tend to throw a lot of information at you, but I'm going to try and go through it in a relatively formulaic way, such that it kind of all resonates and makes a lot of sense. If I'm going too quick, if something doesn't make sense, feel free to throw something up in the chat, and we can try and stop and address it to the best of our abilities at that time. There'll also be a Q&A session at the end. Teresa, if you'd be so kind as to monitor the chat for me, just that way I am alerted to if there is a question. So with that, let's get going. And we're going to try and cover a lot, as I mentioned, in a relatively quick time today. Really, we're going to focus on three big trends. First and foremost, the shift in population and employment patterns throughout major metros in the U.S. Number two, how working from home has upended the urban office and retail market and where we think that's going in the near future. And then finally, the rise in interest rates, how it's weighed on capital markets activity, and how we see that resolving here in 2023. So with that, let's get started. And we're going to start just very quickly with a top level look at how Americans are moving around the country, right? Or really how Americans are shifting amongst large, mid-size, and non-metro locations. Because at the end of the day, as I've always said, demographics are destiny in commercial real estate, right? At the end of the day, it's four walls, a roof on some land, right? What gives commercial real estate value is how we as people choose to use it and where we choose to aggregate around it, right? So at the end of the day, it's really the people, right? And the flow of those people that make commercial real estate so valuable. So I think it's really important for us to always just start with a quick backdrop on where demographics are going. So here we're looking at, from Brookings, three different regional classifications. First and foremost, major metro areas. Those are all metro areas across the U.S. with at least 1 million or more people. I believe there's about 88 of those. Other metro areas, that's going to be the remaining, let's call it 302 MSAs across the United States. So there are 390 recognized metropolitan statistical areas. Those other metro areas are going to be all of those MSAs are with under 1 million people, right? Think smaller secondary, tertiary cities, right? And then finally, our third group, our third geographic classification, non-metropolitan areas, those are going to be people residing outside of those 390 MSAs. So think very rural areas, right? Very tertiary in nature. So as we know, the pandemic shifted where people live and where people work. So on the first focus, just where people live. As you can see here, we've seen a pretty abrupt shift resulting in 2021 in our census data coming from really the pandemic and how people shifted in response to it. So our major metro areas, the areas that have seen the primary have been the source of primary absolute growth, right? Not relative growth, not from a percentage perspective, but from the total number of people, right, being able to be brought into the areas. Our major metro areas for, oh goodness, since post World War II, right, have been the primary areas where people have aggregated. And it's been where we've seen the most nominal growth, right? The most growth of actual people. And we saw that trend really reverse in 2021. And we all know as a result, it was a result of the pandemic. So the population within major metro areas dropped by about 16 basis points or 0.16% in 2021. Now, with that, those people had to go somewhere, right? What we saw is really in tracking the data is that those people that did move out of major metropolitan areas either A, moved into smaller secondary, tertiary metropolitan areas with fewer than 1 million people, as we saw a pretty substantial rise, almost 15 basis point rise in the amount or in the population growth within those smaller areas. And then all the way out to rural non-metropolitan areas, right, where we saw a substantial increase, actually the strongest growth that we've seen from a population perspective in non-metropolitan areas in over 5 decades, right? So there was definitely a shift, right, in where people chose to live. And part of that had to do with where they had the freedom to work. But we'll get to that in a little bit. So focusing in on our major gateway markets, and for this analysis, I included 7 gateway markets. There is some discussion or some debate as to what those primary gateway markets are within the U.S. There isn't necessarily a formal definition. So I tend to always go with our main 6, and then I add Miami as well, because to me, that's an up-and-coming gateway if it's not already. So what we have here is Boston, Chicago, Los Angeles, Miami, New York, San Francisco, DC, right? And as you can see here, each of our major gateway markets outside of Washington, DC has fewer people today, or as of the end of 2021, than they had in 2019. So as you can see here, I put both the figures as well as the relative percentage change, because 93,000 people, losing 93,000 people in San Francisco, right, which is almost 5.8% of the population, feels a lot different than it does in New York, right? So when we look at these figures, we can see that the largest absolute losses came from New York City and Los Angeles. Makes sense. Our largest and second largest metro in the entire United States. Third largest absolute fall was from Chicago, right? But as we look at it from a relative perspective, right, from a percentage of the total population, we can see that really no market has been hit as hard as San Francisco, right? San Francisco's lost 5.8% of its population. And as we look at the fundamental performance of its commercial real estate, remember, demographics are destiny, right? San Francisco has underperformed across the board, across all property types, and has almost bar none been the worst performer of any major metro across all fundamentals, across rent growth. Really, it doesn't matter the property type or what fundamental driver you're looking at. San Francisco has underperformed. And a big part of the reason is this right here, right? It's lost a substantial portion of its population, right? As we know, it's a lot of tech workers who have moved out, whether that be seeking cheaper housing out in Sacramento, or even further east, in Idaho or Montana. Obviously, there's been a substantial upheaval in the tech industry here just as of late. Most of these population losses, though, are not a result of the job losses or the result of a weakening economy in San Francisco. A lot of them are pandemic driven and cost driven, right? Because one thing that we definitely do see is people are moving towards lower cost, lower tax locales. We can see that when we compare the performance of our gateway markets, as you see here, to our faster growing Sunbelt markets, right? This has been a continuation of really a multi-year trend, but a trend that accelerated with the coronavirus pandemic. So remember our gateway markets, right? All losses across the board. Well, where did those people move? In a lot of instances, they moved to these gateway markets, to these Sunbelt markets. So these are some of our fastest growing markets from a population perspective, from an employment perspective, and by extension, from a demand and fundamentals perspective. So Atlanta, Austin, Charlotte, Dallas, Houston, Las Vegas, Nashville, Orlando, Phoenix, Tampa, right? All of these locales seeing either 1.5% to greater population growth since the end of 2019, right? Dallas-Fort Worth, Phoenix seeing the greatest absolute growth at over 360,000 people combined, right? So certainly there's been, I call it the reverse migration, right? There's been this flow of people back out of gateway cities and back into these higher growth Sunbelt markets that are seeing a greater portion of employment growth, that have lower housing costs, nicer weather in many instances, and also lower taxes. So the shifts in population certainly haven't impacted how employment has bounced back in Sunbelt markets, which are these markets here, versus our gateway markets, which were the 7 markets that we looked at earlier. So what I wanted to do is just very quickly take a look at how employment was bouncing back in our gateway markets versus our Sunbelt markets, both of which you saw substantial employment declines during the height of the pandemic during shutdowns. Now, we do know that Sunbelt markets in general took a different approach than many gateway markets when it came to the reopening from the coronavirus pandemic, or simply said, gateway markets were more restrictive and they opened back up later from the pandemic than typically what we saw in our Sunbelt markets, some of which acted like the pandemic never happened. So when we account for the fact that there was this difference in approach, right? So we do know that gateway markets were hit harder, especially that frontline retail worker, that frontline hospitality worker. As the economy entered into a forced shutdown period, those people naturally lost their jobs. Unfortunately, we can no longer give gateway markets the benefit of the doubt resulting from a delayed opening, right? Because they've been open and they've been open for a year and a half, right? So as we look at that more recent, 4 to 6 quarter performance, right? We can see that outperformance from Sunbelt markets has continued, right? And a lot of that has to do with the population flows and the demand resulting from the population flows of these growing Sunbelt markets. So where we sit today in gateway markets combined is just slightly below where we were at in total from a jobs perspective right before the pandemic, right? As of 2019 Q4 versus 2022 Q4, we're effectively flat from a total employment perspective. We actually still haven't fully quite gotten back to where we were at from a total employment perspective in gateway markets heading into the pandemic. Sunbelt markets, on the other hand, enjoying that growth, enjoying the fact that there's that spillover economic activity and overall lift that comes from growing populations, now is sitting with an employment market that's 5.5% larger than it was heading into the pandemic, right? So said another way, Sunbelt markets have outperformed gateway markets since the start of the pandemic in employment growth by about 5 percentage points. Now, these shifts were weighing on apartment markets and causing really bifurcated results from a demand perspective, both in the aggregate as well as in the relative. But we have seen that kind of revert here over the last 4 quarters. So if I would have showed you this chart in 2021, you would have seen a lot more Sunbelt near the top. But gateway markets really did have a strong 2022 when it came to bouncing back from weak absorption in 2021. So what we're looking at here is just across all U.S. markets, right? Which markets absorbed the greatest amount of units, right? Or said another way, which markets saw demand for apartment units rise by the greatest absolute figure. And as you can see here in New York, right, so substantially larger than the rest of the US, led the way at 26,000 units. But in 2021, despite its size, New York did not, in fact, lead the nation, right? So this very much is a story of people coming back into gateway markets, and really, I would say youth coming back into gateway markets. So Washington, Los Angeles, also outperformers from an absolute basis, right? 9,400 units absorbed in 2022 in Washington, 7,700 units in Los Angeles, 6,500 units in Chicago, 4,500 units in Boston, and then 3,800 units in Miami. Now, you'll notice there is one of our gateway markets that doesn't make this list, right? And it's San Francisco, right? As I said, our consistent relative underperformer since the start of the pandemic. But even San Francisco saw absorption gains in 2022. San Francisco actually absorbed a positive 2,600 units in 2022, which was the first year positive absorption they've seen since coming out of the pandemic. So things are starting to look a little better for gateway markets, but from a relative perspective, we are still seeing a much stronger relative growth rate in those Sunbelt markets. So what we're looking at here is that same data point, absorption gains in 2022, right? But now we're looking at it from a perspective of relative to the size of the market, right? And the size of the market in this case is being estimated based upon the total inventory of apartment units within the market. So as we see here, when we start to look at it from a relative perspective, gateway markets still do make the list of overperformers, right? Our top performers are on the left, our weakest performers are on the right, right? But we see, from a relative growth perspective, Sunbelt markets are still, many Sunbelt markets are still outperforming our gateway markets, but not in all instances. We are starting again to see some of that reversion to the mean. We're starting to see some of those patterns that really built up in 2020 and 2021 really start to revert themselves. Some are accelerating, some are reverting. I think it's a fascinating time for commercial real estate practitioners, quite frankly, because we are in this period of dislocation and we're in this period of churn, right? And what we all have to do now is take a step back and say, okay, well, which of these trends, right, do we see accelerating? Which do we see reverting? And how do we actually see that playing out over the long term, right? Because we have to understand that against a backdrop, a multi-decade backdrop of aggregation of capital, of skills, of labor within city centers, within gateway markets, right? We have to understand, is that going to revert itself, right? Simply because of a pandemic that, for all intents and purposes is nearly behind us, right? And our estimation is no, right? Our estimation is that over the longer term, right, as we can continue to move through this pandemic and into the mid and later part of this decade, that we will start to see the strength, right, in the ecosystem of gateway markets take hold again, and we will start to see them continue to capture an above average share of growth going forward. But right now, certainly it's the time of the Sunbelt market, and certainly the time where we are seeing the strongest demand growth, as well as the strongest NOI growth, and by extension, value creation in those Sunbelt markets. So here we're looking at how that demand growth is translating into rent growth. This is another chart that looks very, very different here, showing it to you at the end of 2022 than it did in 2021. Some of these markets at the end of 2021 and at the end of the first quarter of 2022, we're seeing eye-watering rent growth figures of 15, 17. Tampa Bay, over the last year in 2021, grew at nearly 20% rents. Starting to see that heat really come out of the market, especially in those Sunbelt markets, which were growing at just exorbitant rates, right? The market cannot sustain 10, 12, 15% durable rent growth in a world where wages are growing by 5 to 6%. Yes, I understand housing is only typically 30 to 40% of a budget, right? But even still, right, we cannot sustain those kind of rent increases over a durable time frame. So naturally, right, whenever things get overheated, whenever things run at a pace well above what we know they can durably and consistently run at for a long period of time, we should expect what? For them to eventually tire and slow down. And that's exactly what we're seeing really with the Sunbelt rent growth. Now, gateway markets, they never struggled with that, or they never had that same above average rent growth coming out of the pandemic. Actually, they were generally laggards. And as such, as we look towards that reversion, as we look forward, there certainly does appear to be, at least adjusted for incomes, much stronger ability to push rents in gateway markets today than what we're seeing in many Sunbelt markets. Now, bringing in 50, 100, 150,000 people, it's amazing what that does for a landlord's leverage within the market, right? So it is very possible that population growth, right, helps really boost Sunbelt rent growth relative to gateway markets. But when we simply look at affordability, you could make the case very easily, quite frankly, that gateway markets have much better opportunity to push rents relative to incomes than what we see in many Sunbelt markets today. So one other thing I wanted to
Brandon, I have a quick question on that last slide.
yes.
New York was not on that last slide.
What's that?
New York was not on that last slide?
New York
Or this
was
one?
not. New York is, yeah, you're absolutely correct. New York is not on this slide, and that's because it falls right in the middle. So any markets that you see not on this slide, and there's actually two, as I look at this list, it looks like Los Angeles also is not on the list. And that's because
What
both.
is it at the top?
Oh, there it is. There's Los Angeles. Which one am I missing? Hold on, I'm missing one. Miami, Chicago, Los Angeles, Washington, San Francisco. So where are you at? Boston. Okay, so Boston and New York are both not on this list. And any market that's not on this list just means that they're falling in between 4.3% and 3.1% rent growth. Because effectively what we're looking at here on the left are markets with the strongest rent growth. On the right, markets with the weakest rent growth. Everything in the middle is just falling off of the list. So both New York and Boston fell in between that 3.1 to 4.3%. And unfortunately, I'm not sure off the top of my head exactly where they fell, right? But somewhere within that middle of the road range. So one last thing I wanted to touch on as we think about population shifts amongst metros, right? As we think about people and shifting from gateway metros to Sunbelt metros, as we think about gateway metros' ability to still attract young talent and migrants. I just wanted to touch on one other thing, and that is our retail sector. And really that retail is continuing to do what it does, right? And as population shifts around the country, retail is going to follow those population shifts, because what are those population shifts ultimately going to lead to? Consumption growth, right? And at the end of the day, if I'm a retailer and I'm looking at my portfolio and I'm looking to expand, right, where am I going to look, right? The place where I can grab the most potential wallet share, and the place where that wallet share is expected to grow into the future, right? I'm not going into a market for a year or 2 years or 3 years. I'm going in for 5 or 10 or 20, right? So I want to make sure that I'm going into a market, A, where I can capture a lot of available dollars, but B, where the pool and depth of those available dollars is growing over time, right? And as such, we are seeing retailers really follow that rooftop growth into the Sunbelt markets. So two things we're looking at here. On the left, this is our total amount of retail leasing, right? The square footage you can see as the data labels. So for example, Las Vegas, 3.5 million square feet of retail leasing in 2022. And then it's shown relative to how big that is relative to the market. So Las Vegas leased about 2.9% of its total stock in 2022, which is a very, very strong year. So as you can see, when we look at it from a function of the total size of the market, each of these Sunbelt markets are growing at a very, very rapid clip, 2% or above. And as you look to the right, when we look at that personal consumption expenditure growth, that's 2021 PCE growth. We haven't gotten the 2022 figure yet. But when we look at PCE growth on nominal terms, right, so not inflation adjusted, we see that strongest growth being in those areas that are where people are aggregating. Florida, Texas, Arizona, right? A lot of Sunbelt, very consistent with population growth, right? Because when you bring in more people, those people spend more money and you get significant expenditure growth. When you get that significant expenditure growth, it does what? It supports more retail, right? So very much retail's following rooftops into these Sunbelt markets. And as such, we do see a significant amount of our under construction stock, as well as our tightest availabilities in the retail world in those Sunbelt markets where we are seeing that population growth really outperform the U.S. average.
So can I ask a question on that last slide as well?
Absolutely.
I noticed that you have Montana, Idaho, South Dakota is having increased growth rates. So do you have any information on that? Is that really the demographic switch?
Yeah, those specifically are solely almost the demographic shift. Those are the import of workers, primarily tech workers from California, that have really helped prop up a lot of what would be considered other metro areas in Montana, in Idaho, in Utah. So that's really, I think, the push eastward for cost savings in a world where employment locale became much more flexible. Now, the big question on those markets is it sticky? right? And I think as we look forward, right, and we start to think about those markets, particularly tourist markets, secondary markets, in Montana, Idaho, Utah, where there isn't necessarily a professional economic base, right, or a professional employment availability, we do expect some of that to revert. We do expect some of those areas really to see some weakness in the coming years as workers are brought, if not completely back into the office, at least a couple days brought back into the office. And as such, that leash gets a little bit tighter, right? I can't work from Montana if I'm working in San Francisco. If not, I have to come in even 1 day a week, right? And so we're starting to see employers, and we'll talk about this here now. We're starting to see employers really tighten the reins, right? And starting to bring back workers, if not, full-time, at least part of the time. And as such, some of those migrationary trends, which were driven by the freedom to work from anywhere, are likely to revert in the next couple of years. So, way to tee it up for our second trend, which is work from home upending the urban office and retail market. So as everybody knows, the pandemic really pushed a lot of the professional class towards working from home for the very first time. It's been a very slow crawl back into the office, right? By most measures, office utilizations are sitting anywhere between 40 to 60%. Depending on the day of the week. Typically on the end days, you're getting closer to that 40%. In the middle of the week, you're getting closer to that 60%, right? But this is still a far cry from where we were at right before the pandemic. I remember being the last person out of CoStar's Chicago office in March. What was it? That have been March 16th was the final day, March 16th, 2020, when they told us to all go home. And I can't believe that we're still working from home a couple days a week, right? It's just something that I think, quite frankly, is becoming more and more ingrained, and is more and more an expectation amongst many workers, right? And so if that's the case, then we should expect it to at least be relatively sticky going forward. Now, here's the big key though, right? As we think of how it impacts where people aggregate, where population growth is, where employment growth is, again, it only takes 1 day a week to keep people in the metro area. They may aggregate out into the suburbs if they're only there 1 or 2 days a week, right? But 1 or 2 days a week, at least it keeps them in the metropolitan area, right? And so as we're pulling people back, we do expect some of those trends to revert. But let's talk about office demand very, very quickly in a world where we are still seeing work from home be so prevalent. So this is just a quick chart looking at total occupancy. It's indexed in 2019 Q4 to 100. So we think of this as our occupancy rate across the entire U.S. office market, right? And as of the end of 2019, right before the pandemic, we were at 100, right? Or an index of 100. So what we're looking at here is a couple things. First and foremost, one is the historical data. That's our blue chunk to the left, right? The top right, the light blue section is trend. Based upon where we were at, where would we have expected to find ourselves now today? The red is the nominal actual, right? So this is the actual loss in occupancy that we've seen, right? Resulting from since the start of the pandemic. And finally, the yellow is if we were to include the amount of space that's now been put up on the market for sublease, right? How much have we really seen demand reset, right? And as you can see here, we've seen demand fall by almost 3%, a little over 3% across the entire U.S. if we do include that sublease increase. Now, those same trends have hit gateway markets, and actually have hit gateway markets even more significantly. So gateway markets, and again, we're using those 7 markets. When we look at just those gateway office market occupancy rates, we were in a very good place heading into the pandemic, right? We had about 8.5% vacancy across the U.S. market, and we've since now seen that rise to over 13.5%, right? So vacancy rates within gateway markets have gone up by nearly 50% since the start of the pandemic, and they've continued to weaken. Even through the fourth quarter, we continued to see gateway markets give up occupancy and continue to weaken. Now, when we look at demand formation across all U.S. markets, right? And again, we're throwing up all markets so we can get an understanding of how our gateway markets are performing. Really, there are two gateway markets that we've seen over the last year, over 2022, that generated positive demand increases, right? That when we net out the amount of people moving out of space versus the people moving in, we actually saw more move in than move out. And those two were Miami and Boston, as you can see here. Neither one of them necessarily with a huge amount of demand increase, but quite frankly, any increase at this point in time was a welcome sign coming off of 2020 and 2021. All
Brandon,
five of our other gateway markets, yes.
Is this slide office or all inventory?
This is
Commercial.
office. Sorry, I'll when I circulate the deck, I will specify that here. It should say net absorption as a share of office inventory, or office net absorption as share of inventory, however you want to skin the cat. So yes, this is just office space. So for example, San Francisco, right, in just 2022, saw demand for office space decline by 4.6 million square feet. Right, Los Angeles saw demand decline by 2.9 million square feet. Right, Miami, conversely, 1.1 million square feet of positive net absorption. So when we looked at this chart 2 quarters ago, nearly every single market was negative across the entire U.S. We're now starting to see more and more markets turn positive, and most of those markets tend to be either A, cheaper Midwest markets, or B, our Sun Belt markets. Now, on the right end of the chart, we see all of those markets that are still losing demand for space. Now, we are currently tracking more markets that have lost demand for space in 2022 than have actually gained demand, right? And we expect, quite frankly, this to continue because we're still seeing sublease availability rise. So companies are still putting their excess space on the market, and when we're seeing leases get signed, oftentimes we're seeing them get signed for lower square footages. So overall, we don't feel like the worst is behind us. We do feel like we are going to continue to see occupancy slip in most gateway across the U.S., probably at least for another 4 to 6 quarters before all of the weakness is built in. And we still have a fair amount of new construction coming online as well, right? So in certain markets, especially like Midwestern markets and some of our smaller markets, we have virtually no new supply threat, right? So we can be losing some demand, and that's painful, right? But it's not the 1-2 punch of both losing demand and gaining new supply, which some of our gateway markets are going to see. For example, Boston. Now, luckily, Boston has seen positive demand trends over the last year, but they have 17.5 million square feet of office space coming online here over the next 6 quarters, over half of which is still available today, right? And so as we start to think about those occupancy figures, we need to start to adjust them for, okay, well, how much space is coming online in the next 4 to 6 quarters, and how much of that space do we expect to fill, right? And we're obviously tracking the leasing on the filling. And while the space, quite frankly, that we've seen come online has been reasonably successful in attracting tenants, it's really doing so at the expense or to the cannibalization of older stock within metros. So, slide's running away from me there. So what we're looking at here is the change in demand for office space, looking by the age of the property. So we have pre-1980, right, our older legacy stuff, 1980 to 1999, 2000 to 2009, and then finally 2010 or newer. And as you can see, really going back every quarter all the way to the pandemic, and really continuing a pre-pandemic trend, right? Most of the demand in the marketplace has been for newer office product. Now, you'll notice though, when we look back at 14, 15, 16, we are still seeing some positive gains in the older stuff, right? And it was because there just simply wasn't enough new stuff to go around, right? But as the Class A market, as the newer built market has loosened, we've started to see that cannibalization really tick up, and we've seen those weaker or older buildings really struggling to compete in this environment for tenants, right? And the only thing that you really have to compete on, quite frankly, if you're especially pre-2000 building without a recent redo, is on cost. Right, it's a race to the bottom on cost, but the problem is you're going to be competing with everybody else in that older, right, weaker building class. So it becomes a really, really difficult situation. And it's one that, quite frankly, we expect to be resolved through demolitions and repurposings. Now, office to multifamily repurposings are not as easy as what the media would like you to believe, right? Everybody just says, oh, well, let's just repurpose all this office into housing. Fantastic. It is super expensive. It is very hard to do. There's a lot of hoops, and a lot of times there are just structural issues with the office building itself that makes it very, very difficult to transform into housing. But in certain instances, it's going to happen. We know in Chicago, Mayor Lightfoot obviously announced a new package for LaSalle Street. It is something that there is a lot of public push behind. And if you throw enough public dollars at it, we will start to see it materialize as more of a trend. But quite frankly, right now, it's very similar to taking a mall and turning it into an industrial park, right? It sounds great. The economics make sense. Good luck getting all of the public approval, the regulatory approval, and all of the things that you need in place, right? So that's all just to say it's going to be a long, slow road to recovery for a lot of these older legacy assets, whether they be in gateway markets or in secondary markets. Now, we are still continuing to see availability rise in gateway markets. And a big part of the reason is really twofold. First and foremost, the continued rise of sublease availability. And second, the available space in under construction stock. As I mentioned earlier, we have about a 13.5% vacancy rate currently today in our gateway office markets. But when we include that sublease space and we include that available space in under construction stock, we see that nearly 18% of all office space is actually available today in gateway markets, right? Remains very much a tenant's market. It remains a very concessionary environment in most instances, right? And it's, again, going to be a very long, slow road back to full recovery. And the reason is just because of, one, the dislocation between the growth in demand for jobs, relative to office space. I used to need 225 square feet for a worker, and now I may need a worker only 3 times a week on a hot desking assignment. Overall, we expect there to be a lower use allocation resulting from each job created, simply because that worker's not in the office 5 days a week, right? So when you couple that with the fact that we are seeing office employment slow down, right? And we're hearing talks of recession, whether that be severe or mild. I think most are erring on the side of mild now. Those combined are going to create a really, really difficult environment to regain some fundamental balance within our office market, right? Because if A, I have to grow more jobs to create the same amount of demand lift than what I used to, and B, I'm now growing fewer jobs in these gateway markets, right? It becomes a really, really difficult task to try and fill all of this space that went vacant here since the start of the pandemic. Now, when we look at office availability rates for gateway markets, we can see that most markets did rise still all the way through 2022. The only exception being Miami and Chicago. Both Miami and Chicago actually saw their office availability rates decline in 2022. Chicago very, very minimally. Miami actually by about 1.5%, right? Miami's kind of been the outperformer. It benefits from the fact that it's in Florida, that it's in a low-cost locale. It really benefits from the Sun Belt growth factors. So it really is kind of its own unique performer relative to these other gateway markets. But all the other gateway markets, we did see availability continue to rise. And in Boston and San Francisco, it rose substantially. but for two different reasons, right? San Francisco, we saw availability rise because we lost that 4.5 million square feet of demand for space, right? But in Boston, we saw it rise really because we saw more groundbreakings, more new construction, and the available space within that new construction start to hit the market. So really, two different stories creating a very similar looking chart of availability rise. So one last thing I wanted to touch on the office side was the fact that we are starting to see that office employment growth slow down. For those of you who aren't aware, we consider office employment to be information, financial activities, and professional and business services, right? So when we add up all of the jobs in those categories, typically office using categories, this is a measure by which we forecast demand, right? When we look at where we're expecting to see those office jobs come in. And historically, it's one where we've always seen this strong correlation between demand and office using employment, right? So as we've seen office using employment slow down, right, we are expecting to see new leases, new demand for office space slow down with it. And as we know, we've been in this weaker environment anyway, and this is why we are expecting vacancy to continue to rise here over the next 6 to 8 quarters before we start to see some moderation. So population shifts, we talked about it in the last section, right? How they're shifting amongst metros, right? People leaving large metro areas, going into smaller metro areas, but they're occurring within metros as well. And actually, in a lot of cases, they're occurring even more prevalently within metros. So what we're looking at here is that same Brookings data, looking at population shifts, but now we're comparing within metros, right? How is the growth in urban counties versus suburban counties? And as you can see here, similar trend is what we saw in our larger metro areas, but even a much stronger trend where we did see a substantial loss in population by over 1% in urban counties in 2020, compared to what we saw in the suburban counties, right? So 85 basis points of growth in suburban counties. That was actually a little bit slower than what we saw in prior years, right? But significantly outperforming the 1% population loss that we tracked in urban counties, right? So overall, we saw the pace of population growth, household formations really slow down during the pandemic, but they certainly impacted some areas more than others. And a big part of the reason that we saw that outflow from the urban core was really a shift in domestic migration, right? So when we look at the various sources of population flows, right, the three main ones being domestic migration, international migration, or just natural increase, right, births minus deaths, we can see that in urban counties, there had been downward pressure, right, on the growth rates really from all three sources heading into the pandemic. But in 2020, 2021, we saw this substantial decline, right, or outflow of domestic individuals, right? Migration within American citizens and American people already within America, moving out into those suburban counties. And with that, we saw this uptick in the suburban population growth. Now, part of this is simply the age curve of America. Part of this simply is the fact that the largest generation in American history is in the process of moving out of urban environments and having families and starting to raise them in suburban environments, just like every generation's done post-World War II. So part of this is demographic and life factors, right? And a simple shift. And then part of it is resulting from the pandemic and the acceleration out of the urban core that we saw as a result of that pandemic, right? And as we think about this from a function of retail, as I mentioned, retail just looking to aggregate by rooftops, looking to capture dollars, this shift has created a dislocation between the CBD and suburban performance in gateway markets for retail. What we're looking at here is just those 7 gateway markets. If you aggregate them all together and you look at the performance from a demand growth perspective in the suburbs versus the CBD, you can see that in 2020, both were hit hard. 2021, 2022, we started to see that growth back out in the suburbs. Actually, it's really hard to find good available space in a lot of suburbs in America today. We have not yet seeing really that same growth pattern return to the CBD. So overall, when you add up the last 3 years, we lost over 32 million square feet of retail demand within CBDs across the U.S. And quite frankly, we're just still sitting at a very, very weak position. As polled as of yesterday, currently about 23% of all retail space within CBDs of gateway markets is currently being marketed as available for lease. Now, when we look at those same gateway markets, but we flip out to the suburbs, you can see that we're actually sitting just slightly above 5% at our lowest availability in gateway market suburbs that we've seen, actually going all the way back to 2006, right? So again, real estate, commercial real estate simply just being where people choose to aggregate, work, shop, and live, right? And as we've seen those population shifts, we're naturally seeing the tenant base shift around it. The last trend I wanted to talk about today is just the rise in rates and its impact on capital markets, because I think it's so critical to where we are today. Overall, we had a decent year for 2022. Actually, from a historical perspective, we had a phenomenal year in 2022 across all property types across the entire US, right? $850 billion of commercial real estate volume traded across the US in 2022, which was by far the second best year on record. But it was a pullback relative to 2021, and we did see activity slow in each quarter, right? I always like to say 2022 was like a balloon with a small hole in it, right? It started out full. It still looked full at the end of the first quarter, but it slowly started to let out air, right? And actually all property types except one, and that was hospitality, did see a pullback in activity. So it was broad-based, right? The pullback in total volume, albeit moderate, was across the board, across all geographies, or across all property types. And it was also across most geographies. So what we're looking at here is just Q4 sales volume across major US markets and how it compared to the average of the prior 8 quarters, right? To try and get an understanding of, okay, where did sales volume in Q4 accelerate versus decelerate? And remember, Q4 typically the strongest quarter of the year, right? So the fact that Q4 was our weakest quarter of 2022, I think is really telling us something, and the fact of where momentum's at currently within the commercial real estate market, right? So across the board, nearly, other than the Inland Empire and Savannah, we saw pullbacks in Q4 in all of our major markets, and really across all property types, right? So New York, Los Angeles, Chicago, Boston, even if we go to our high growth Sunbelt markets like Dallas and Atlanta and Phoenix, everybody feeling the pullback, everybody seeing activity overall pullback, right? And a big part of the reason is because the run up in rates, right? It does not matter what my source of debt is. I'm paying probably 200 to 250 basis points more today than I was at the end of 2021, right? So this is just a chart showing the various forms of CRE financing. You got REIT debt, you got the REIT preferreds, you got CMBS debt, you got the conventional secured, right? So your traditional bank mortgage, agency lending for the multifamily side, and then relative to your 10-year treasury, right? And as you can see, that run up in the 10-year, right? When we see that risk-free rate move up, what happens? Rates on every other yield product adjust, right, to maintain that same liquidity and risk premium. And that's exactly what happened here in 2022. So we've seen the risk-free rates run up. We've seen a huge run up in interest rates. And what that's done is it's pushed cap rate spreads to their tightest levels since 2009. What we're looking at here is just the BBB effective yield, right, or the effective yield on BBB corporate bonds, right? We use that as a measure because typically there's a healthy about 2% spread over corporate bonds to cap rates. Right? And that's you can consider that to be the liquidity premium, as well as probably a little bit of risk premium in there as well, right? So if we recognize that typically there's this 200 basis point spread, and we look at where we're at today, right? This is our long-term average spread between the end across property types, and this is where we were at as of Q4 2022. And this is the difference, right? So typically, for example, in retail, we have about a 2.5% spread over corporate bonds. Today, that spread's sitting at about 40 basis points, right? The difference is about 2.1%. What does that mean? It means investors, right? If they were to go buy at current yields using today's interest rates, right, are receiving about a 30% lower return, right, after we adjust for the financing costs. So this is really across the board, right? It does not matter if it's retail, office, industrial, multifamily, hotel. Yields today on commercial real estate are based upon interest rates yesterday. Given the interest rate rise up we've seen, yields today just don't make sense. There's a lot of times that deals still get done. 1031 capital, foreign capital making its way into the U.S., debt maturities, right? There are reasons for deals to still get done. There are things that still elicit deals to happen, right? But simply put, right, investors today, based upon current yields today, are not being fully reimbursed for the risk and the liquidity that they're taking on by buying commercial real estate relative to how they've been compensated over the past 15 years. Does that make sense? Over the past 15 years, we've come to accept a much higher leverage adjusted return than what investors are receiving today. And so what happens? A widening of the bid-ask spread, right? Investors are looking at today's values, right? Sellers are looking at yesterday's prices. You get this dislocation, right? Widening of the bid-ask spread, as we call it, price discovery, as other people call it, right? That's the period we're in today. And it's typically resolved in only one way, and that's through price declines. And that is what we are expecting in 2023. Now, when we consider the fact that gateway markets hold just due to their liquidity and due to a multitude of factors, due to capital flows and capital desire to be in these markets, we typically see anywhere between a 30 to 60 basis points lower yield on gateway markets versus other markets, right? So if spreads are this low relative to the entire U.S. average, right, add another 30 to 50 basis points, and that's where gateway markets are at. So we do think that 2023 will be a reach for yield, right? It's going to be a year in which investors will do deals that make sense, where they can get the returns that they need to get. And in a lot of instances, they're not going to be able to find those returns in gateway markets. The other thing that we're tracking as well has just been an overall pullback in debt liquidity, right? Really across the board, whether you're looking at CMBS debt, whether you're looking at life co debt or conventional financing, we've seen all financing sources really pull back, right? And we see this definitely when we look at our CMBS origination data, right? We were typically originating $30 to $40 billion every quarter in CMBS debt across the country. In the most recent fourth quarter, we did just slightly more than 7, right? So we are just not originating the same amount of new financing, right? But we have a substantial amount of maturities here coming over the next couple of years, right? And this wall of maturities, coupled with the pullback in financing availability, really will help hasten the pricing declines that are necessary in order to restore the yield gap that commercial real estate needs to have over corporate or treasury bonds. So overall, our outlook is for 2023 to see a pullback in pricing as investors demand a higher return, and we start to see some sellers capitulate to current values, which they were really hesitant to do in 2022. We've also seen that refinancing risk increase meaningfully, right? And we are expecting an increase in maturity defaults in 2023 as certain borrowers are unable to refinance their loans and are unable to dispose of their properties before their maturity. So that's all I had for you today. I left exactly -1 minute for questions, so you're welcome for that, Teresa. Expected to get through that a little quicker today, but as always, it was dense and a lot to cover.
Well, if anyone would like to ask a question, please raise your hand and put yourself on the screen. I know I have a couple questions. My first question is, but before you did this analysis, you had preconceived ideas based on, regularly doing analysis. What was the most surprising trend that you found?
I would say that the most surprising trend I found is the fact that CBD retail availability continues to go up. in a world where the renters are coming back, right? In a world where workers are coming back, albeit not as quickly as maybe some of us would like. But I find it, to me, still fascinating that the CBD retail environment remains as weak as it is when we're hitting on 2 out of 3 levers. And what I mean by that is tourism in most markets is back, right? The apartment renters in most markets are back to where they were pre-pandemic, right? The only thing missing is really the office workers. And in a lot of cases, that's only 40% of the time. But we're not yet seeing it be enough to entice retailers to move into those locations, right? And I do think we're going to see some reversion of that in 2023. But to me, it's telling me that if the demand is coming back, but the tenants aren't, there's like some still dislocation in the economics of the rent, and ergo rents are going to fall, right? So we're going to see CBD retail rents come down in 2023, and that will hopefully start to elicit demand and start to backfill some of the space, because 80% of the demand that the retail tenants are looking for in the CBDs is back, right? In many instances, right? They're just not back yet, right? And so I do expect that to revert in 2023. But in order for it to happen, we're likely going to need to see some of those CBD rents come down.
Dr. Mustafa, you have a question?
Yes, I have a question. Just want to get Brandon's take on population shifts regarding global warming and the effects it has on the sun belts. And investors are saying they are taking a look at the replacement costs to move in the sun belt areas, and also employee satisfaction. Just go through a hurricane one time and you may not want to live there anymore. So just want to get your take on the possible population shifts from the effect on global warming in the sun belt areas.
Yeah, absolutely. And a great question. It is one, quite frankly, that I think investors are sleeping at the wheel in a lot of instances. A lot of it always has to determine with, what is your horizon, right? First question of anything, what's a good investment right now? What's your time horizon, right? So I think a lot of it does have to depend on investors' time horizons. But longer term buy and hold permanent capital, quite frankly, should be very, very concerned and very attuned with what's going on along the coast and what's going on in our Southwest desert, right? Because I, for one, happen to believe that Chicago will be, one of, and I'm a bit biased maybe, but Chicago will likely be one of the benefactors of migration shifts resulting from global warming. I do think that the Midwest and the Great Lakes region is going to eventually, it may be, 2100, but if we can all accept global warming is real, if we see it before our eyes, look at what's going on in California, look at hurricanes, look at forest fires, look at all the flooding, right? That will have an impact. It's not yet, right? Because right now the costs are still too small relative to the opportunity, right? But eventually, right, as more properties, as flood insurance goes through the roof, right? And that's going to be one thing that's all of a sudden going to change the economics and take a little bit of the shine off of Florida, right? Despite whatever rent growth you think you can get, right? As we see the risks materialize, as we see the storms grow more intense, as we see sea levels rise, I do think you are going to start to see more of the economic risk built into those deals. And as that happens, right, you're going to see capital reallocate or just expect a higher return to compensate itself for those increased risks, right? I just don't think that as of right now, capital is looking at those. Some are, I talk to people every day and some very much are, right? And a lot of people aren't, right? A lot of people that's too out in the future. They're still too far removed from the consequences for them to currently consider them to be real perceived risks. That will shift. And when that shifts, I expect those markets in the Great Lakes, where they do have the infrastructure to take on more people, where they do have fresh water sources, where they do have mild temperamented climate, all to, quite frankly, benefit if we're to believe even, a third of the climate models. So I hope that addressed your question.
Yes, it did. The replacement cost was one of the things that I was concerned with in reading some of the articles, as you indicated, the value of those properties and from the hurricanes, the tornadoes, the heat, whatever can happen in those areas. It seemed like they haven't done any studies to look at exactly what the replacement cost will be for those buildings for the next 10, 15, 20, or 30 years. So we're looking at maybe just a minimum amount, maybe a 5-year projection as opposed to a 30-year projection on the replacement cost or the cost of these buildings.
Yeah, an absolute astute point, and not just, the buildings themselves, but who's gonna live there and be there, right? Can Phoenix continue to grow without a water source, right? Can the coast continue to attract people who can't afford flood insurance for their homes, right? So I do think that there are going to be some pretty significant shifts, and to your point, I don't think anybody is really looking at how those shifts are going to impact the values of those buildings.
Thank you.
So Alina has a very good question, which you may or may not be fully prepared to answer, but she was asking how you compare the U.S. gateway cities to other cities outside of the U.S. And it might be something that you have to get back to me on some data, but what are your initial thoughts?
Yeah, absolutely. I will have to get back to you with some data because I am U.S. focused. CoStar is global, but I myself am US focused. But let me get in touch with our Canadian team, our UK team, our European team, and see what I can get back for you.
And then I'll wrap it up with a final question. Let's say you have $100. How would you allocate it investing wise? And so you could say, okay, this amount of percentage in capital markets versus real estate. And here's the kind of numbers, whether it be asset class, cities, et cetera. Like how would you look at that investment portfolio?
Oh, well, I was not prepared for that one. All right, so I can go multi-asset class here too.
You have $100 to invest.
Oh,
whether it's 100 million, whatever, scale it, however you have it.
Yep.
You have money to spend. How would you allocate it?
I would. It's a good question. Modern portfolio theory would tell me, no, I'm just kidding. I'm young, so I would be relatively risk averse, right? And so I would take a longer term horizon. For that reason, I would be, more exposed to equities because I still think that over the long term, I think Warren Buffett has it right? That the US is a growth engine and that's not slowing down. It might shift, but I don't think that that's slowing down. Currently, I would be looking at REITs over private real estate because REITs have already adjusted to the interest rate change, whereas private real estate still is a little bit slow to react. From a sector within commercial real estate perspective, I think that retail, quite frankly, is very overlooked and specifically well-located multi-tenant retail. In a lot of ways, it's still trading with the risk premium of 2018, 2019. And quite frankly, I think that risk premium applied to retail, especially well-located shopping centers, should be much lower and much more consistent with what we apply to other sectors like multifamily and industrial. So I think there's some relative advantage there. And then long term, I still think that at the end of the day, we are in the midst of the technological revolution that will continue, right? So I think investing in the technology that we will all utilize in the future, right? And all of that will be driven by what? Microchips, right? So I understand there's some supply weakness in the near term and whatnot, but I'm a big fan of the semiconductor sector. So with a little bit more time and preparation, I may have come up with something different, but off the top of my head, I'm thinking a lot of REITs, longer term, a lot of semiconductors, balance out some of that risk with maybe some corporate bonds.
Okay, great. Thank you very much, Brandon. We appreciate you presenting today. This presentation will be hopefully both on the NICAR and the NICAR YouTube. And we appreciate everyone who has attended. If you have suggestions for future presentations, have connections in other countries, we always welcome great presenters that want to talk about hot topics in commercial real estate. You can reach out to me, Teresa Mueller of Trillium Real Estate. And I thank everyone for participating. We are going to end the recording and have a quick networking.